And in the meantime, I'll introduce myself. My name's Bevan Pierce. I work at Grow Accounting, and I'm here with Tasha Hungerford, the principal here at Grow Accounting. Like most of the people here today, we're also a small business, so not only can we advise small businesses from our professional experience, we can certainly overlay some practical experience alongside that as well. So today is really where we want to start the small business journey, and that's to do with choosing the right business structure. And the business structure is important because, as you'll see, it dictates a lot of the outcomes that you may want from your business. And what we'll talk about is how you can set your goals for your business, and we've got some follow-up webinars coming up tomorrow, the day after, and the day after for that, and how you can incorporate those goals right back to decisions you make early on, like your structure. So, albeit nothing's really ever set in concrete, if you have an idea about where you want to go, and based on that best information you've got now, you put the right structure in place, you're going to be in a position at the end of it to achieve the best outcome, even if that outcome changes. So we will start off with a poll in a second, but the whole presentation today should take around about 45 minutes. And if we've got time, we've allowed another 15 minutes at the end for questions. If you have a question as we go along, just type it in the Q&A box and we'll reply to it if we can, or we'll provide a follow-up email with the answers to the questions. If we don't get around to answering your specific question, don't worry, we will get back to you with it. In terms of information, there's more information available from the Business Queensland website. Also have a look at our website, or if you wanted to give us a call or drop us an email afterwards, we're more than happy to have a chat to you or respond to your general questions by email. If you would like some specific advice, then clearly we're here to help you achieve your specific goals, and we can provide you with advice about your situation. Just as a general point also, the slides will be available on our website, and a video of the presentation will be available on our YouTube channel. So we'll send those links out after the presentation. So without any further ado, let's get into it. Okay, so who are we? We're a Sunshine Coast-based accounting firm. We've got clients all over Australia and in fact all over the world. We specialise in small business, and we've got a large property focus as well. Now, business and property go hand in hand in terms of building wealth, and we find that a lot of our successful business clients also have successful property portfolios. So our expertise is well positioned to provide that advice. We do use technology to achieve our outcomes with our clients, a lot of Skype meetings and so on for clients that aren't local. We clearly love to see local clients, so if you're in and around the Sunshine Coast, then feel free to drop in, because Tash and I do love to have a coffee and a chat at times. We operate on a fixed fee basis for our clients. So those fees can include our proactive services such as tax planning and our business improvement advice as well. So it's very important, I think, that in a small business you surround yourself with people that are able to complement your own expertise. And while we may not know your exact business, there's probably a good chance we have several people or several clients in a business very similar to yours, or over our not short history, we have come across problems that are the same ones that you're facing. So certainly rely on your accountants and your advisors for advice, and take that advice. That's going to be a recurring theme that comes out of all of my presentations anyway, is don't be that client that says, yes, I like your advice, but, Be that client that says, okay, think about the advice and incorporate it into your future planning as you see fit. So I've already mentioned the follow-up, so you can drop us an email or just give us a quick call and we'll have a chat about how we can take things further from there if you want any further advice. So the objectives of today's presentation, well, legal schmeagle, this isn't advice. I would not like for anybody to go away today and make decisions for their own business based on this presentation. It is very clearly only general information. And as you'll see a little bit later on when we work through a case study, the outcomes aren't always that obvious. Even though some of the ideas are fairly simple, there's so much complexity in people's situations that the subtleties of those variances can sometimes have a big outcome on what the best advice should be. So just a note, this is just general advice to give you a general understanding. We're going to summarize the different structural options and outcomes that are available to you and those factors that you should be thinking about when you're making a decision about your structural option and your best structural option. Most importantly, we're going to give you something to think about, okay? So go away, think about some of the core concepts that come out of today, think about how they apply to your business, and think about how they apply to what you want to achieve in the future, and then set about incorporating them into your planning. Because it's really important that the outcomes that you can achieve from having the right structure in place early on in business are so far superior than the outcomes that you might achieve with the wrong structure in place. And that sits across tax, it sits across wealth, it sits across asset protection as well. And we'll touch on all of those throughout this presentation. Also, one of the key things that is also going to run through our presentations today, tomorrow, and Wednesday is how you get your money out of your business. So how you get paid from your business is really important, and the ways that you actually can unlock some of the cash in your business tax effectively come back to the structure that you have in place. So in some cases, we have zero flexibility about how we do that, and we can't save you 1 cent on tax. Okay. Other cases, we have almost infinite flexibility, depending on the scale of your business, of course. But if you're earning over $37,000 a year from your business and you're trading as a sole trader, for example, you're paying too much tax. I'll tell you that for an absolute fact. But we'll get into that today, tomorrow with the financial statements and a little bit to do with the planning one on Wednesday as well. So we kick on to the, oh, we were going to have a poll. We were. Let's do that now. Let's do a quick poll about what stage your business is currently up to. So this is a little bit just to get to know you guys as attendees, and a little bit to get an idea about where I can tailor what I'm going to talk to about, because it's pretty flexible and I want to make sure that you get some value out of it. So here we go. We'll leave a minute or two for this poll to be open and just answer the question there about what stage your business is up to. Okay, so one attendee is looking to wind down their business. That's very interesting. Very interesting. You might be able to reconcile perhaps some of what we're talking about today with the position you're in and how we project that forward to achieve your objectives. So most of the people here are in business, either established or just started. And as I mentioned, one fellow is looking to wind down, person is looking to wind down their business. And a couple currently at concept. So look, that's fantastic. Thank you very much. That gives me something to address some of the flexibility in as we go through, and hopefully we can meet your specific requirements by the end of it. Okay, so we have 4 options basically for a business structure. You can trade as a sole trader, you can trade as a partnership, you can trade as a trust. Now, whether that's a discretionary trust, a unit trust, or a hybrid trust, which is a combination of a discretionary and a unit trust, that'll depend on some of the nuances of your situation. For today, though, I'm fairly much going to focus on discretionary trusts when I'm talking about trusts. In terms of unit trusts, they can be proxied with much of what we talk about as far as a company structure goes, with the exception of capital gains tax. So if there was likely to be a significant capital gains tax outcome for your business at some stage, we wouldn't really want to see that in a company, because of course a company doesn't get the 50% capital gains tax discount. So straight away, you're going to be paying twice the amount of tax that you should be. We would look to perhaps a unit trust in that situation, as opposed to a company and as opposed to a discretionary trust. But we'll work through the key things to think about for each structure. You can apply them to your own situation, and hopefully by the end of it, you'll get a pretty good idea about where you should be placing your investment for your business structure. Also, at this point, I think because people are already involved in business, it's not always too late to change. A lot of people think they're locked into what they've got. The major issues with changing a business structure once it's been set up, quite apart from the logistics of bank accounts and brandings and ABNs and all of those things, which are pretty minor relatively, come down to capital gains tax and have you created any value in your business? If so, then what is that going to be? And occasionally stamp duty. So is there stamp duty going to be involved if you're going to be restructuring your business? But they're not insurmountable, and it will depend at the end on the benefits that you perceive of the change as to whether you take the change forward or whether you just bite the bullet and stick with what you've already got. So look, we're going to run through an overview quickly of these four structures, and then we're going to dig deeper into them and the reasons why each one may or may not be appropriate. The core thing to bear in mind is that there is no perfect solution. The solution will depend on your business, what you want to achieve in the future, your budget, your level of participation, and all sorts of other factors that fold into it. So just because a company might be right for John, who runs a business that on the face of it looks pretty similar to yours, doesn't necessarily mean that his business, that a company is going to be suitable for you. So just bear that in mind. There is no right and there's no wrong answer. So the four options: sole trader. What are the advantages? Well, it's cheap to set up, okay? You have total control and there's no separate legal structure required. It's pretty easy if you're running a business that doesn't have any future potential scale and has got limited risk. It's not a bad way to go. A hobby that you want to turn into a business to monetize and perhaps generate some sort of tax advantage, although be careful about that because there is some tax laws around non-commercial losses. So it's only suitable for small scale, absolute liability back with the sole practitioner, and there's limited tax planning because all profits are yours. And like I said earlier, if you're earning more than $37,000 as a sole trader, it's almost certain that you're paying too much tax. Partnership, well, there's no advantages. I'm absolutely not a fan of partnerships and I don't like to waste too much time on them. The only time I can think they would be appropriate is if you're legally required to trade under a partnership, which really these days doesn't happen at all for any industries that I can think of. They can be costly and complex. Not only do you carry your own risk as your sole trader, but you also carry the risk of all of your other partners jointly and severally. So you're liable for every single dollar of risk if you're trading in a partnership, and your partner is liable for every single dollar of risk for you. The key thing to understand about that is that it's the creditors that will pursue the partner they think that has the most outcome of giving them some funds, okay? So if your partner's got all his assets locked away and you've got your family home available, then as a creditor, I'm going to pursue you and your family home, and I'll let you deal with your partner about whether there's any compensation due to be paid after I've got my money from you. There's limited tax planning flexibility because generally it's the agreement that will determine who gets the income and capital, and to change the agreement requires a legal change. It can also be difficult to bring in new partners. So partnerships we'll probably steer fairly clear of and just brush over today. A trust. So again, I'm talking about a discretionary trust. And with a corporate trustee, a trust can provide maximum asset protection. Now, a trust itself isn't a legal structure. It's legally controlled by the trustee. So in that way, you can think of the trustee as a parent of the trust. The trustee is the one that legally holds everything in its capacity as trustee. Okay? Maximum tax planning for a discretionary trust, because we can do what we want with the money largely, provided it's within the terms of the trust deed, and we can draft a trust deed that's so broad that we can do what we want. So maximum tax planning can pay wages to principals, so that's a way to get your income out if you want to get wages. It can also make distributions free of PAYG and free of superannuation guarantee if that's something you want to do. The trust can also lend to principals. In current law, so a trust can lend funds to a principal, so you can have an overdrawn loan account with the principal without too many adverse consequences. They could be subject to legislative attack. So that was probably prior to the election. Now I think things will settle down a little bit, and Mr. Shorten's certainly on his bike towards the sunset. Whether the Labor Party pursues that at the next election, who knows? They cost more than any other structure to set up and run if you get a corporate trustee, because you effectively have to set up two structures, the company as the corporate trustee and the trust itself. And they can't retain earnings. So if you're making high profits, you need to get those earnings distributed to somebody, or the trustee pays tax at the highest marginal tax rate. And clearly that's not suitable. We can have strategies though whereby we put in a bucket company and we can cap those tax rates on those earnings off at 27.5 cents in the dollar. I'm not going to go into those in any detail, but there are options there. A company. Well, a company provides maximum asset protection through a thing called the corporate veil. So the corporate veil basically means that shareholders and directors are not liable. Directors can be personally liable for some tax costs and for some other costs, especially if they're trading while they're insolvent, but with the right advice, we should be able to avoid those personal liabilities. A company has some limited tax planning, low tax rates for small business enterprises at the moment, which is good. Can pay wages to principal, which is good. Can pay dividends to principal as well. So if the company's paid tax in the future, it can distribute those retained earnings as fully franked dividends, which can be useful in some circumstances. Okay? Can easily bring in new shareholders, and there's long-standing laws surrounding the governance of companies. So it's well known what a company can and cannot do. Cost is a medium sort of cost to set up, $100, $1,500, $2,500, depending on how far you want to go with your shareholders agreement, and we'll come back to that in a little bit more detail. Cannot easily lend to principal. So unlike a trust where you can just draw money out of the trust bank account as a loan, if you do that with a company, then you're captured by a thing called Div 7A, and some special tax rules apply. Importantly, for a company, there's no capital gains tax discount available. So if a capital gain is part of your future strategy, then perhaps a company isn't ideal for your structure. So what are the considerations? What are the things you need to think about when you are deciding on the right structure for your business now and in the future? So first of all, we have participation. So participation relates to, are you going to be operating the business by yourself or mum and dad together, for instance, or are you going to be wanting to bring in independent partners? And I use the word partners in a very loose sense here. In the future, a sole trader clearly can't have any sort of partnership. A partnership can, but there's the risk issues. The trust, the discretionary trust can't. but a hybrid or a unit trust could, and a company most certainly can. I mean, every owner of Telstra shares in Australia is effectively a joint owner of a limited liability company. Asset protection. This is the big one, and this is the first thing that I focus on whenever I'm talking to new clients. It must be the primary consideration for everybody, in my view, because almost without fail, businesses are here to build wealth for us. Now, it's no point building wealth in a business if you lose all your assets through some incident, should I say. And it's very important that I think everybody understands that asset protection is the number one priority for choosing your structure, or should be, because it's like I say, it's no good building wealth if you're going to lose it all. And let me give you an example. A client runs a cleaning company. Now, this isn't a real example, but it demonstrates my point. Client runs a cleaning company. They've employed a staff member as a cleaner. That staff member goes into a client's house of theirs and cleaning the painting on the wall, accidentally spills some cleaning fluid on it, and all the paint runs. Now, unbeknownst to the staff member, that painting was an original Picasso. So all of a sudden, you as the business owner are completely liable for the actions of your staff. Your staff have no liability. So as a business owner, you're vicariously liable for what they do, and you may have a suit against you. Now, you may have insurance, which is great, and your insurance company may or may not pay, but we all know insurance companies don't always like to pay. You know, a flood apparently isn't a flood when the water rises through the drains. Who would have thought? So while insurance is a good level of protection to have, you need the backup protection of having the right structure in place. So some structures will allow you to shut the company down without any personal, or shut the business down without any personal risk to yourself. If you're a sole trader, you lose everything. Now, if you're a sole trader in that situation, it doesn't necessarily mean that you're going to lose everything and that that's a bad strategy. We might be able to move the assets away from yourself. So, you know, but in general, we want to have the business isolated to a legal entity where all the risk is contained and there's only limited personal liability from that business. Third consideration is taxation, and it comes after asset protection, and taxation comes back to what is the basic point of having a business. The basic point of business is to build wealth. Even not-for-profits build income that they can use for distributions and so on. So the less tax that you pay, the more wealth you have. If you're earning $100,000 and paying $20,000 tax, you've got $80,000 worth of profits that you can apply towards your own lifestyle, okay? If you're earning $100,000 but paying $30,000 worth of tax, then you've only got $70,000. So taxation is really important for achieving the wealth outcomes that most people require from a business. Future objectives. If your objectives are to build a business to sell, then it makes sense that you wouldn't want to be building that as a sole trader. It's very difficult to separate that business as a saleable asset, okay? If you're building a business just to generate a sideline income or a second income, then a sole trader might be appropriate. So your future objectives are important. If you don't know, then you need to make a decision now about what the most likely future outcome might be. So it's important that you consider what you want to do at the end of the business. Some observations. So I'm not a young fellow anymore. I've been in the industry for 30 years. And there's some things I see over and over again. I think the key thing here is when you're entering a business or just started up a business, don't be unreasonably focused on cost and seek advice. Seek advice early and take that advice. Don't be the client that says, I like what you're saying, but take the advice, take it on board and think about it. Understand your business model and realistically consider what you want to achieve and by when, because that's really important. And that folds into our webinar tomorrow on financial statements and the day after on planning. Understanding how your business turns that $1 in sales into probably 15 or 10 cents worth of profit to your pocket at the end of the day is critical to being able to plan your future business and being able to maximize your outcomes. Consider multiple structures specifically with respect to structures. So you may have a trust owning the shares in a company. You may have your family home owned by your partner who's not associated with the business. So there's multiple levels of asset protection and there's multiple levels you should be thinking about. It gets really complicated really quickly. So again, I come back to point number one, seek advice and take that advice, please. If there's nothing else you take away from today, then please take that away. A little bit later on, we're going to have a case study about Jenny and her chocolate empire. So we're going to work through some of the subtleties of structure with that case study. But until then, we're just going to dig a little bit deeper into the individual structures that are available and how they compare against each other on these critical considerations. And that's perhaps going to give you a practical way you can apply what we're talking about today to your business. So a sole trader, fine for a small hobby type business or a business where you're generating a second income. But if you're serious in business and serious about growth, it's probably not all right. Could be, but probably not. So let's look at those elements. Participation, none. You're a lone ranger. You're running by yourself. You're by yourself. You can't bring a business partner in if you're trading through a sole trader. It just doesn't work. Asset protection, there is none. Unless we move your personal assets away from the risk, in which case we can achieve something, then you have zero asset protection trading as a sole trader, and your personal home, your car, everything that's in your bank accounts could be exposed to that cleaner accidentally wrecking that Picasso, okay? So it is really important that you understand that asset protection should be your number one decision metric for choosing your structure. Taxation, none. All profits from the business get taxed to you at your marginal rates. So if you are operating as a sole trader and it's your only income and you're earning more than $37,000 a year in profits, you're probably paying more tax than you have to, okay? That's because the marginal tax rate at $37,000 for you as an individual goes from 19% to 32.5%. The company tax rate for a small business is 27.5%. So ideally, if we can get you $37,000 worth of income to take advantage of the tax-free threshold and the low tax rate up to $37,000, and bank the rest of the income to be taxed at the company tax rate of 27.5%, then every dollar you earn as a sole trader over $37,000 is going to be costing you 5 cents extra in tax. Now, sometimes that's not always appropriate, but it outlines the taxation inefficiency of being a sole trader. Future objectives. Well, you're a lone ranger. You can't have any future objectives. If you want to sell your business in the future, it's going to be very difficult to separate yourself from that business. Cost. It's cheap. That's the only factor that this comes in on. But short-term cheap might be long-term expensive. Partnership. Look, I'm just going to whiz through this because I'm not a fan of a partnership. It's difficult to make changes. Joint and several liability. Taxation, there's no flexibility because you're generally going to be established by the partnership agreement. Future objectives, again, it's not easy to change without legal changes. And the cost, it's about mid-range. So it's less than the cost of a company trust structure, but it's higher than the cost of a trust alone or a sole trader. Discretionary trust, and again, discretionary trust with a corporate trustee. Participation, it can be difficult with a discretionary trust. With a unit trust, not so much, but with a discretionary trust, it's difficult to fix entitlements. Asset protection can be effective with a corporate trustee because you have the protection of the corporate bail. Taxation, flexible. What we did last year, we don't have to do this year. Our son's just turned 18, so we're going to give him $20,000 worth of our income tax-free. Now, we don't have to give him the cash. So Tash will run through that tomorrow with the financial statements presentation, but we can distribute him on paper $20,000 worth of profits tax-free. In fact, it's better than that, $20,400 by the time you take in the low income rebate. Future objectives, limited. Limited for the same reasons that the participation is limited. It's difficult to bring in new partners, but it is easy enough to separate the assets of the business for sale. Cost, probably the most costly structure, a trust with a corporate trustee. But if it's worth it and it's worth doing right, then the cost really is fairly small still, at around about $2,000 to $2,500 to set up a trust and a corporate trustee, okay? Limited liability company, participation's maximum. Telstra hasn't got many shareholders that change every day. Thousands of shares change hands every day. They trade as a limited liability company. They wouldn't be able to do that if they were a sole trader, a partnership, or a trust. So maximum participation for shares. I would recommend that you consider a detailed shareholders agreement if you're looking at setting up a company and bringing partners in, because that shareholders agreement is really critical to dealing with three factors that we won't touch on much today, but they are dispute resolution, how the individual participants in the company are going to be remunerated, and preemptive rights, which means if one of the shareholders wants to sell, then generally they have to offer it to existing shareholders, and there's some mechanism there for valuing shares, etc. So if you are going to do a company, an additional setup cost on top of that is a good shareholders agreement. Highly recommended, particularly if you've got independent partners or your objectives are to bring those in the future. Asset protection, the corporate veil protects shareholders. Shareholders don't really have no liability. They have liability up to the amount of any unpaid capital. So if we issue 100 shares for $1 each and they're not paid up front, then the shareholders' liability is $100 on liquidation. Directors do have some personal liability, but it's personal liability that can be fully managed, provided you don't do anything that's outside the rules. So that's trading while you're insolvent, lodging BAS returns late, not paying super, all of those things can provide personal liability for directors. But properly managed, that liability becomes a theoretical liability, not a real one. Taxation. We have some flexibility in taxation through a limited liability company, but it's limited, okay? There are rules around how much a company can lend to its shareholders, and if that goes in overdraft or that becomes a debit loan, then there are specific rules around how to deal with that penalise companies for giving cash out to their shareholders and related parties more than they've put in. Future objectives. Well, a company clearly accommodates future growth because you can bring in as many shareholders as you like. Issue new shares to your heart's content. It's not a problem. Cost, about mid-range. So it's a reasonable cost for a company, $1,000, $1,600, $2,000, somewhere in about that, and maybe another $1,500 or $2,000 so if you want to get a shareholders agreement, which I absolutely recommend. So now for our case study, Jenny, okay. So let's look at the factors for Jenny and pay some attention to this because we're going to have a little pop quiz at the end. Participation. Jenny's own business. She might employ her children, okay? She's not sure, but she might. She probably will employ other staff. Asset protection. Jenny owns her own home, 50-50 with her husband. She has 2 rental properties in her own name and will fund $200,000 worth of equipment from savings. Now, this is fairly typical of clients that we see in early stage businesses. You know, they're wanting to grow. They fund that from borrowing against their own home or from savings, okay? So we've got a whole lot of asset protection elements that we want to factor into the decision for Jenny. Taxation. She's got 2 adult children and a 16-year-old daughter in year 11, okay? Important, because adults 18 years and above have access to the tax-free threshold for unearned income. And by unearned, I mean not wages. Wages, they have access to the tax-free threshold, but unearned as in a dividend or a distribution, okay? Husband earns $80,000 a year from a salary. Jenny's parents live with her and have a small income. Again, Jenny's parents could be critical for some of our tax planning decisions, maybe, maybe not, depending on the specific situation. Jenny's future objectives. So she's thinking the business will be profitable. She's identified a niche market for her chocolates with a turnover around about that $800,000 mark. Okay. It's possible trade sale, or a daughter might take over the business in the future. So not 100% sure, but probably sure that she's not going to trade the business until she dies, or she's not going to trade the business and just let it run down. Okay, she is building a fairly substantial asset here with the business. So one way or another, she wants to unlock that value at the end. So Jenny's main considerations: participation, okay? Sole trader, yeah, she's not really got any ideas for any future business partners to come on board. A sole trader could be appropriate, right? Trust or company could be appropriate too. They provide for that future participation if and when it's ever required. So my advice would be, while a sole trader provides for no future participation, let's keep the options open and let's go with a trust or a company. Asset protection, only provided by a trust or a company. Taxation, the maximum outcome by a trust, some flexibility with a company. Future objectives, a trust or a company. So building a valuable asset to sell, we ideally want that to be separate to the individual. So a partnership and a sole trader, probably not, a trust or a company. Okay. Now, some observations from my experience. There could be a few correct answers here, all right? But decisions can't be made with hindsight. We have to make a decision now about what we think is the most likely outcome, okay? Seeking advice early is critical, because once she invests in plant and equipment, it's going to be much more difficult to change. And once she starts growing her business, that change could incur fairly substantial capital gains tax and stamp duty costs. Don't be unreasonably focused on cost. She's building a significant business. She's throwing $200,000 of her savings into it. To save $500 now and get the decision wrong could lead to a disastrous consequence at the other end. Understand your business model and be realistic about what you want to achieve and when. When is really important, okay? The when is important because you might want to get rid of the business or sell the business in 2 years, in which case we need to accelerate your business growth, all right? You may be 10 years down the track, in which case we've probably got a little bit of time to suck and see, and maybe some flexibility for some future restructuring, all right? And consider multiple structures, okay? So that's my advice to you guys. What I'm going to do now is run a poll to see what you think is the best outcome for Jenny and her business, given the circumstances we've just outlined. And bear in mind, there is no right answer and no wrong answer. Okay, guys, we've got 5 more people to answer. If you haven't answered yet, please just chuck your answer in there. And yeah, there's no right or wrong. You're not going to be judged on it. It's just important, I think, to get a feel. And I'll say now that nobody will get the structure that I would recommend, right? Because there's a whole lot of information about Jenny that you don't know. So it's really just to test your own thinking against what we've talked about. So I'll give it another few seconds, and if those 5 persons do not wish to vote, then that's okay, no problem. We've got most of the cyber room voted, so let's close that off now and see how we got on. All right, so there's the answer. Trust 8, 53%, and a company 47%. Well, you know what? You're both right. This is what my advice to Jenny is. So let's work through it. At the top, we've got Jenny here. She's a shareholder and director of a trustee company that's a trustee for a discretionary trust. Now, that discretionary trust owns shares in a trading company. Okay, so this is the business here. Now, the reason we've done that is because we can separate this trading company for any future sale easily. We can also get tax planning advantages with the discretionary trust. Jenny's business is not going to be insignificant. Okay, still probably small, falls within the mandate of a small business, but it's not going to be insignificant. So we're going to have some tax planning opportunities, particularly with her children and with her parents that are living at home. We've identified that. And trading through a company is going to make that business separable, and it's also going to give her double the protection in terms of corporate veil. Okay, so that would be my advice to Jenny, albeit a little bit sneaky that I bought some extra things into it. So it's just to demonstrate really some of the nuances of that information that we may not have on the face of it, so, and how they interrelate with other pieces of information. So, you know, it's very complicated getting your structure right, but it's very easy often to get it wrong. So we need to make a decision, and even if we're trading as a sole trader or, God bless, a partnership, as long as it's a decision that you guys have made with full comprehension of the reasons and the likely outcomes, then I applaud you. Go ahead, operate your business through that structure and do really well. That's it for me. Any questions, if we don't get an opportunity to answer them, we'll send out an email with a link to our website where we'll put a summary, also a link to a recording of the video. So thank you very much for your time. I understand business is tough and busy, and getting time away to do these things is not always easy. So thank you.